What's going on, guys? It's Kyle. Welcome to the Stock Goat YouTube channel. Be sure to smash the like button. Let's try and get this video up to 1,500 likes. Don't stop smashing it because SoFi is exploding right now. Be sure to drop me a comment. Ask me any questions you want about, SoFi or the overall market. I'm going to answer everybody's questions. Okay, the stock market is not doing anything today. I believe every index finished, barely red, while at the same time, growth stocks are absolutely exploding. Why is that? That's because a rotation is happening. These investors need somewhere to put their money right now because what they've been telling you the past 6 to 9 months about buying value, 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 it's not working. I don't care if a stock is returning billions to their shareholders. I don't care if it's a highly profitable company. I don't care if the dividend's amazing. The problem with a lot of those companies, the reason why they're value, there's a reason why the stocks are value. It's because they don't have explosive growth. And this type of environment right now, that is showing. These companies are reporting barely any growth at all, these profitable companies, and their stocks are getting sold off 20, 30, 40% at some point, guys. It doesn't matter if your company is profitable. It matters right now if your company has sustainable growth in this potentially, recession environment that we're, entering right now. Okay. And that's why I believe investors are heading to the growth stocks, route right now. So as we've been feeling the pain for the past 6 to 8 months, it's time for those value investors, those CNBC analysts, those professional Wall Street analysts cutting, the growth stocks price targets. It's now their turn to feel the pain. And that's why they're having to unload these value stocks right now that are just getting crushed. Margin calls and FANG, value techs getting hammered. It's time to buy growth because growth is massively oversold. Growth is the future and growth has sustainable growth. They're trying to acquire market share. That's why most of them are not profitable, gaining so many customers. I just want you guys to know that we've had our pain for the past 6 to 9 months, and it is now time to rally for a long time because these are the companies that are going to be showing massive growth every single earnings, not going backwards. I'm investing in companies going forward. Let's get into the video. All right, guys, take a look at that. Look at the top. S&P 500, red. Dow, almost 1% red. NASDAQ, even red. Russell small caps making a little bit of a comeback. Crude oil even down 1%. SoFi was up, I believe, at 10% at one point today, up 7%, up another 2% in the after hours. Market cap should be around maybe 6.5 billion or something like that. I got to double check exactly because we all know Yahoo Finance is not updated. But guys, this is a really great sign. We need to take a look at our list of 100 stocks to see what is happening inside of this market. So if we go all the way down to the bottom, there's not a lot of massive selling. I believe the selling is exhausted at this point when you're talking to NASDAQ down 30%, but we could see Target, Walmart, Apple, MasterCard, Costco, JP Morgan, that value tech trade, all of those companies right there, Visa, Walt Disney, these are all at the bottom, selling off anywhere in the 1 to 3% range. And if we scroll up into the top 40, we can see Robinhood, Affirm, PayPal, Fintech, all up 4 or 5%. ChargePoint growth up 5%. There's a big rotation coming into these stocks that have been selling off because these companies, even though most of them are not profitable, at least they're showing sustainable growth, for these past earnings and decent guidance for Q2. Block, Snowflake. Now we're getting into the top 25. Upstart up 6.5%. SoFi almost finished in the top 20 today out of 100 growth stocks. We also have Matterport, Lemonade, Rivian, Shopify, a lot of cloud and SaaS plays. We've been talking about these stocks selling off more aggressively. These are coming back pretty quick. Cloudflare, Sentinel-One, Fastly, Datadog, a lot of cloud as you can see. We also have Lucid up 11% and Nubank up 13%. So all of the growth stocks are making a huge reversal right now while you have, companies like Apple, Cisco, Costco, Walmart, all the way at the bottom. And I'm going to show you exactly why value stocks, value tech as well, like some FANG stocks, they're not safe investments right now. I'm going to show you those details inside of this video, so wait on it. CEO Anthony Noto bought 105,000 worth of shares, 13,500 units at $7.79, increasing direct ownership by almost a 0.5% to 3.2 million shares. Guys, he made some big buys last week or two. Some of them were 300,000, 300,000. So Anthony Noto just continues to buy. And I know why he's buying. He's buying day by day, averaging down, averaging up. It doesn't matter because they keep beating every single earnings. 9 months in a row of double earnings beats. Why would he not buy his stock? His stock's not going backwards, like a Target, Netflix, Walmart, Home Depot after Q1. He's going up. This stock has not been red since Q1 earnings. I'm telling you right now, the guidance was solid. Somebody said they missed guidance. I think they missed it by 2 million or something like that. That's not going to get your stock going backwards. A 2 million, guidance missed. And I believe they're going to blow out that 340 very easily. SoFi short interest, I don't know why there's a line right here, guys. Sorry about that. But as you can see, short interest has declined 2.88%. That is still not that much, guys. We're still at 20+% short interest, 147 million shares short. This is massively shorted. I'm telling you right now, I was looking at some of these, mega caps at the beginning of the year. These stocks were shorted 2 to 3%. They are treating this stock like a dirty ragdog, terrible earning stock, okay? 20% short right now. This is not enough covering, guys. I'm telling you, there is so much room to run right now. I mean, I believe SoFi should not be shorted any more than 10% as a fintech right now. So these guys are disgustingly trapped right now. They have to cover eventually because the Nasdaq's going red and growth is going green. So that's even better, okay? You want to see these indexes continue to fall and fall and fall. If fintech's going up while these are falling, like an Apple, Amazon holding those indexes down, you want to see that, okay? That's just going to give you more upside when the index is reversed. So as you can see, guys, short interest is ridiculous. Normal short interest on a regular, larger mega cap, 2, 3, maybe 4%. This is disgusting, okay? This is like Tesla short interest 10 years ago when I believe Tesla was short at like 30% at one point. So this is really bad. There is a lot of room to run in SoFi. So why is a value stock recommended in this time, okay? You see dozens and dozens of CNBC analysts. You see the Morgan Stanley, they're recommending, all these value plays. Why are they doing that? They're doing that because they're profitable companies. They return money to their shareholders, nice dividends, nice sustainable growth. But I'm telling you right now, this environment is pretty rough, and those value stocks are value for a reason. They're value because they don't have ridiculous growth. That's what a value stock is. There's not crazy growth. Guys, take a look at Target right now. 3% growth. Guys, buying a value stock with 3% growth is 10 times higher risk than buying a fintech right now. Just so you know, 3% growth can get your company selling off 1/3, okay? That is absolutely terrible. JP Morgan, banks, profitable, value. Revenue dropped more than 5%. So they're not even reporting 3% growth like Target. And JP Morgan is getting destroyed because they want to have business, everywhere, okay? And Russia is really hurting them. And that's why, negative 5% revenue growth is absolutely terrible. And that's a value stock. That's a bank. That's a legacy company. You also have Lowe's right here. Scroll down a little bit, 5% growth. So this is actually one of the better value stocks, okay? 5%. I still think that is 5 times higher risk than buying a fintech right now. There's barely any growth in this environment. It could get worse. It could slow down more. We have Walmart earnings right here. Revenue grew 2.4%. You're better off buying a SPAC stock with no revenue that can put you a dream story than buying a company with 2% growth. You're going to sell off on your earnings ridiculously. I think the biggest Walmart drop in decades just happened, okay? You can't report 2-4% growth. It's just terrible. And Cisco, you had one of these CNBC analysts, hyping the stock up. I'm not concerned about Cisco. I forgot her name. She's a super value investor. These companies are high risk. You need to be buying unprofitable growth stocks in this potentially recession we're entering, okay? You need to be buying unprofitable growth because at least they're going to be freaking growing when their earnings come around, okay? We know by now everybody's, losing money that's investing in for the future, okay? Guys, 3%, 5%, 4%, -1, -5, Target, JP Morgan, Lowe's, Walmart, Cisco. Those are some high risk plays. And look at what they did after earnings, and look at what SoFi's doing after earnings. SoFi's going up because, they double beat. Even though they're a money losing company, they are still heading forward. They're not going backwards. That's what you need to be buying right now. And that's why we're seeing a nice bounce in growth. And you're seeing the indexes continue to sell off because you got that heavy weighted Amazon, Apple still bringing it down. Even Cisco's heavyweight, Costco. Those companies are reporting barely any growth. That is not the type of companies you want to be buying right now. All of those analysts that were pumping these stocks when the market was very strong, they are now feeling the pain because their growth is catching up. They're going from 15% growth to 10 to 5, now to negative, some of them, okay? So now you know why you're seeing a big rotation back into growth tech right now. And I believe SoFi, bare minimum, fair value should be at least $15. Even in this environment, guys, we definitely have a lot of room to run. You can see the short interest is ridiculous right now. And if you made it to the end of the video, I want to say I really do appreciate it. I enjoyed doing this video for you. It sounds crazy. I know what I just said sounds absolutely crazy, okay? Someone recommending unprofitable fintechs and growth stocks right now. But look what's happening after earnings when you buy those value tech stocks. They're going down like penny stocks because there's no growth. Who cares if you raise your dividend when you just reported negative 5% growth? Who cares? Investors don't want to hear that right now, okay? They want to hear going forward and not going backwards. Once again, my name's Kyle. Be sure to smash the like button and don't forget to subscribe to the channel if you are not subscribed yet. You have a great day.